will be great. So I appreciate you being here. 64% of you, this is your very first time being at one of our What the CEO Needs You to Know. Look, I know it's going to be fast paced, but it's going to be beneficial. I don't necessarily need you to cue in on what Bank of America is doing, but more importantly, I need you to cue in on what are the principles that are driving this and what can we get out of it if I go look at my own company as well. So I appreciate that. So this is about 64%. Welcome. Appreciate you being here. So when was the last time? Oh, actually, the other thing here is, are you a graduate of one of our programs? So if you've ever been to one of our building business acumen programs, we do them virtually. Maybe you've seen a keynote, but have you attended a program? Sometimes we do up to 2, 3, 4 full day sessions in person. Let me know if you've been to one of our programs, if you're a graduate of one of our programs. Now, in those workshops, typically we do those and they're customized to your company as well. So those tend to be very, very helpful. So great. About 49% of you so far, about 45% of you have attended a program, and about 16% have never attended one. Some of you have attended before these last couple of years. Awesome. Appreciate that. So we're going to go listen to, or at least recapture and debrief what happened in Bank of America's latest earnings call. I want you to think about your own experience. When was the last time that you personally listened to an earnings call? So when was the last time you listened to an earnings call? Now, I'll be the first one to admit, listen to an earnings call? Maybe not, just because you've got time. And so there are other ways of doing that. For example, you can go download the transcript, download all the presentation. You can listen to recording later. It's a great, it's a great experience the first time you get to do it. Sometimes you really want to listen so you can get the tone of what's going on. Some of you, 45%. So 65% of you, this is your first time, and 44% of you have listened to an earnings call this year, which is awesome because it's not even end of March. So you've already been listening to earnings calls. That's great. 2% of you would rather go to the dentist. Yeah, I get that. Sometimes they're painful, right? They become a different language. Like, who are they actually talking to? Are they talking to me? Are they talking to investors? Are they talking to analysts? The answer is yes. Yes, all of the above. Now, here's what's interesting. You think about the information that is in those calls. Here's a CEO, here's a CFO, here are executives, and they're sitting there talking about past performance and what they're going to do next. Now, here's some big challenges to think about that information beyond just understanding the language that they're using and the metrics that they're using. Like 95% of employees don't understand the company's strategy. Well, that's interesting, right? This is kind of, hey, strategy is where we're going, what we're trying to do, the guideposts of how we're going to operate the company. And we talk about strategy in these earnings calls, or executives do. So here's a point that we can listen to our strategy, but most people don't understand, don't have that connection. Now, here's another interesting tidbit about strategy. One of the top levers of driving employee engagement and your own engagement in work is understanding why we're doing it. It's having a connection to strategy. So there's no doubt why a lot of people have a hard time engaging in the work and feeling fully engaged in the work because we don't have a connection to strategy. Now, here's the other part. And this goes along again. How do we engage ourselves? How do we engage our team members in the work and get that extra little bit of effort, right? Go beyond just collecting the paycheck. Well, what do? We got to understand where we're going, and we've got to understand that our job is important. And now here's the problem or challenge. I won't say problem, but here's another challenge that we have in business. 90% of people don't understand key business metrics. Now, why are key business metrics important? They measure our success. In other words, they measure our progress on achieving that strategy. So the strategy tells us why we're doing what we're doing, and the metrics show us progress. They show us the impact of our decisions. So if we don't know where we're going, we don't know if we've had the intended impact. How do we make good decisions? How do we know? How do we engage? So those are two really, really key challenges to think about that I think if we can use these earnings calls just slightly differently, will help close the gap on both of those things. In fact, I'll show you this. Our promise to you is as you do this, it will close those two gaps. It will make an influence. It will have a positive influence on your career. It will build your credibility within your own company and outside of that company as well to understand the business, to understand strategy and performance. And that will have a big impact not only on your career, but on the company that you work for. So here's what I want you to think about. You've got these two big challenges that most people in your company, I want you to think about being a CEO. Most people in your company, 9 out of 10, don't understand the strategy and why we're doing what we're doing, and don't understand the key business metrics, how we're measuring our success, how we're measuring our progress. So if you're a person, if you're like Brian Moynihan, and you're the head of this huge bank, the second largest bank in the US and the sixth largest bank in the world in terms of assets. And speaking of assets, you have over 3 trillion, that's like two pinkies, right? $3 trillion in assets on the balance sheet that you're responsible for, and over $3 trillion in client balances as well. In other words, you're a custodian of their money, whether you're actually managing it for them or providing them a service where they can go manage it for themselves. Over $3 trillion in client balances. That's a lot of responsibility. Not only that, but you've got over 213,000 employees. You measure expenses and payroll in billions of dollars. And you're at the head of this brand that's been around for over 200 years. Now think about the pressure. And you're giving this information on a quarterly basis, knowing that 95% of your employees don't understand why we're doing what we're doing. And 90% of them don't understand the key business metrics that we use to measure our progress. Now, if you're Brian Moynihan and you've got these opportunities every quarter, what would you want those 213,000 employees to know? What do you want them to hear? What's the message that you want to convey to them? What about your customers, your clients? Now, Bank of America, we're like, relationships are super important. They're the key to what we do. What do you want our clients, those people that have chosen to form a relationship with us, what do you want them to know about our strategy and performance? How about shareholders? Now, we're a publicly traded company, so everything we do has to build value, not just for employees, not just for clients, but also shareholders, the folks that actually own the risk of the company. And finally, what would you want other vendors or partners to know? Now, there's a lot of information, and you've got to balance this. And again, here's my guarantee. As you kind of take that perspective and try to close those two gaps, the strategy gap, the metrics gap, like I said, a couple of things. You do this religiously, you will learn the language. You will build influence, and that influence within your company is going to build your credibility inside the company, inside your industry, and beyond. And that's going to help your career, and it will have a positive impact on your company. So my challenge, if anything, is just help you get a little bit of curiosity to go and do this every single quarter for at least your company. Now, we've got a tool here to help you do that. It's the quarterly earnings call workbook that you see here on that slide. There are 3 parts of the process in this workbook. I'm going to show you how to use it and the power of doing these 3 steps. First of all, you've got to prepare. Then we'll do the analysis and the application part. Now, the preparation, there are some things that we do need to know about earnings calls. First of all, they're not required, but they're extremely helpful. Companies that generally hold earnings calls, now they'll release earnings. If they're a publicly traded company, they have to release earnings on a quarterly basis, but they don't have to do a call. And not all companies do it this way, but generally what you will find in these calls, you'll find it in 2 parts. First of all is the prepared remarks. Now, they have a communications department. They've got an investor relations department. And they work together. The executives work together with these departments to carefully craft the message. What message? How did things go in the past quarter? Where are we going? Carefully crafted messages. They're not speaking haphazardly. They're not most of the time shooting from the hip. So pay attention to those prepared remarks. What are the carefully crafted communications that our executives need us to know? The second part is also very interesting. It's a Q&A time that the analysts that follow these companies can ask about performance in the past. And generally, they're trying to get an idea for where the company is headed in the future. Now, analysts have an important role in this, but just to keep things kind of, let's be honest here, right? Candid, analysts just want to be right. So the better information they can get, the more right their models are and the better recommendations they can give us. But what those questions give us is an idea for the concerns in the market about strategy and about the performance. So that's the first part, understanding the structure of these calls, carefully crafted communications to help us understand strategy and performance, what's impacting the business. So here's what I recommend that you do before any call. Before you listen to the call, first of all, locate the transcript, the call or transcript. So most of the times you can go on and just Google, like for example, I would just go Google Bank of America IR, investor relations. And one of the very first things that pops up is going to be Bank of America. So let me show you here, Bank of America IR. Bank of America IR, investor relations. That's what I'm looking for. Sometimes they'll have these quarterly earnings. Sometimes they'll have these events and presentations. Let's just see what quarterly earnings bring us. Okay, so here's 2023. The latest quarterly earnings ended December, fiscal year ended December 31st. I've got the earnings release. Yep, I want to get that. I've got the earnings webcast. Well, I'm not going to do that, but I'm going to go listen or going to go read the transcript, right? I want the 10K. The 10K is the form that is required by law for them to file at the end of every year. At the end of every quarter, look for the 10Q. Okay? So you're going to go get these materials. Sometimes the supplemental information can be very, very helpful too. I'd encourage you to get all of those things, but at the very least, do the release, do the transcript, do the presentation, do the 10K or the 10Q. Okay, awesome. Once you've got that, what you want to make sure you're doing is you also want to review your notes from past calls. What does that tell you? Well, you're going to see the progress or the decline, and you're going to see how the strategy shifts. And then you're going to mate it with the decisions that you've seen all year. And what that is going to allow you to do this, how is it going to help you? Well, you're going to start looking, not just understanding the language, which can be a big impediment, but knowing the progress that you've seen, the shifts in strategy, the shifts in decision-making, and putting the performance there gives you the why we're making some of these decisions and allows you to start peeking around the corner, right? Anticipating what's going to happen. And think about that. If you can anticipate what's going to be happening in your business and get ahead of the curve, think about what that'll do for your influence and credibility within the company. And then finally, meet with your team. We're all smarter together. So make sure you meet with your team and just talk about what's going on, get their ideas and see what we're doing. So once you've got all that preparation, now is when you need to analyze. You need to dig in. So here's a tool to use. 65% of you, this is your first time. Maybe you haven't seen this. You're not super familiar. But 5 simple things that any business has to focus on: cash, profit, assets, growth, and people. And these business drivers are well aligned with the performance, the 3 main financial statements that we look at. So let me just give you real quick. I want to show you 2 things. First of all, if this is one of your first times or you need a refresher, in this quarterly earnings call workbook, you have the 5 business drivers there. And under each business driver, you have a quick definition and discussion of what that is, and then examples, things to listen for or read try to capture in your notes as you read those transcripts. So let me real quick go through these 5 business drivers and what they are. Cash is the prime resource in any business. If you want to start, grow, or even maintain the business that you have, we've got to have cash. And we think about cash in 2 basic ways. Number 1 is very, very similar to our personal finances. We need to have a savings account. Companies need to have access to cash on hand right now to be able to do whatever we want with it. Okay, so they have to have cash position and they've got to generate cash. To stay in business, we've got to generate cash over the long term. Companies that run out or don't have enough cash flow have to go find it another way, or they run out of business. Having cash is not enough. We want to make sure that we're making good decisions. How do we do that? Well, we look at the income statement. I call the income statement, and this I'm stealing from a participant several years back. One participant, the light bulb went off, and she said, "Oh, so the income statement is the statement of knowing what the heck you're doing." That's exactly right. We look at the P&L, profit and loss statement. It's another name for the income statement, to understand how well we resonate with our customers. Well, if we've got a product or service that our customers like, they're going to buy from us. That's called revenue. And if we can make the good decisions where more money's coming in than's going out, that's called profit. Profit is a surplus. So we're going to measure how well we do this, right? How well we operate the company to drive revenue, to make sure that we make money on our products and services. That's called gross profit. To make money in our core operations, supporting those sales, right? All the overhead, HR, IT, all of that sort of stuff. That's called operating income. And then we want to make sure that we're making money after all the things like taxes and interest that are paid as well. And that's called net income. So that's our bottom line. So we want to make sure that we're profitable because that'll help us stay in business in the long term as well. Assets, we're looking at financial strength. That's what keeps us in business. But we also need to make sure if we're going to invest in those assets, they're actually utilizing those assets to put money in our pockets. So when you think about assets, again, that keeps us strong, it keeps us stable, but we need to be able to utilize those assets to drive a return. So strength and utilization. Growth, of course, we got to grow, right? Even if we're happy with the size of the company, growth is not just an increase, but it's an improvement. So we need to be improving over time as well. We want to stay relevant. Most common metrics of growth are revenue growth. Hey, how well do we resonate with our customers? And profit growth. How well are we operating the company? So grow or die, right? So we want to make sure that we're growing over time, and people are at the heart of any business. Tesla even found this out. They couldn't eliminate people completely. We need people, whether that's our external customers, people that are buying from us, or people outside of the organization that are going to have an influence on our financial performance and our strategic progress, as well as internal colleagues. So we want to be able to perform well with both, understanding, anticipating what our customers are going to need and what job they're trying to do, and making sure that we engage our internal customers, our colleagues, because culture eats strategy for breakfast. So we've got these 5 things: cash, profit, assets, growth, and people. And we're going to look at Bank of America. So I'm going to show you how to use this framework and this tool to better understand your quarterly earnings calls through the lens of Bank of America. And again, this is where the tool comes in. We've got the definition. We've got things to listen for. And what we're going to do is, as you read the transcript, you want to just put a tick mark next to each of the appropriate drivers. So that's why it's important to have those things. Like, what are we looking at? And with cash, we're looking at sources of cash. We're looking at dividends, cash investments, those sorts of things. Profit, we're looking at margins or profits or expenses, revenues, those sorts of things. And we're just going to put a tick mark every time we read a message about that. I use colored highlighters. It works well for me. Do whatever works well for you. But pretty soon you're going to find that there are maybe 1, 2, or 3 drivers that get the most attention. That's where these questions come in. Now, these questions come in to help you read between the lines. So what driver gets the most attention? Why would that be? What is it about that message that is so important? And the other questions go along with it. So if that's the important part, and that's the focus for the executives at this time, what are a couple of the main points they're trying to make? What about goals and trends related to that driver? And then we said the Q&A is also important to understand what concerns are there. Sometimes they'll identify challenges and want to know how the company is overcoming some of those challenges. So what key questions are the analysts asking? And that'll help solidify the message in terms of what do we do, the application part. So let's jump in. I want to show you how we can use these 5 business drivers to better understand the message. Now here, this is a kind of one of the closing comments and the prepared remarks from Brian Moynihan. Here's a quick hint. I look at the very first paragraph that the CEO has, and I look at the very last paragraph that the CEO reads as well in the prepared remarks. Sometimes the CEO will come back and summarize the whole call again after the Q&A. If they do, I look for that. Now, this is the end of Brian's prepared remarks. Remember, carefully crafted communications here. He says this, in summary, this was a good quarter. Now, what does a good quarter mean? It means that we delivered our 3rd quarter of expense declines. Expenses, okay, that's one of the key words for profit. So this message is about profit. We saw our NII. NII for a bank stands for net investment income. So in other words, we go deposit cash in a bank. That bank then lends it out. Now, sometimes that bank will pay us interest. That's the cost, the net interest, the interest expense for a bank. But then they'll lend it out in the form of loans or mortgages or whatever they may do. And they're going to collect interest. So there's their interest income minus the interest expense that they're paying us. The difference between those two is net investment income. So now he's saying, by the way, it's one of their key banks' key part of revenues. So we already saw one message about expenses. Now we see another message around revenue. So we saw NII, net investment income, outperform what we expected when we talked to you on the last earnings call. We continued to manage well through the transition and rate structure. So he's already acknowledging here are a couple of challenges, right? You coming out of COVID, you think about what's going on with rates. Now, interest rates highly impact their net investment income. So he's already acknowledging some of those challenges. Now, if you're thinking about this transition and rate structure and how they've come through it, you might also be thinking about growth. So we've got at least profit here. Now, as we look a little bit forward, this next section, we saw deposits grow this quarter. Now, deposits are a key part of a bank's balance sheet. So their balance sheet is assets, right? So we're talking about deposit growth. So assets and growth. And we look forward, again, forward-looking growth with a strong capital base. Strength is assets, that balance sheet. Strong liquidity, again, assets and the strength of the company there. And growing loans in the past quarter to a great 2024. So we see there, it's a message around growth and assets. Now, you should know about banking. Banking lives and dies on its balance sheet. So to be able to make it through any transition, any challenges, they've got to be able to make sure they've got a really strong and growing balance sheet so they can get the earnings that they need to be able to create the value, dividends to shareholders, all that sort of stuff. Now, lastly, I want to thank my teammates for what they did for us in 2023. And we all know we're off to a nice start for 2024. So that's people. Hey, look, we don't operate. We're a bank. Relationships are critical to us. So relationships with our clients, but not just with our clients, relationships with our colleagues, with our team members. So here's Brian Moynihan, the CEO of the 2nd largest bank in the US, 213,000 teammates. Thank you for what you did for us in 2023, and we're off to a nice start. Okay, so that's kind of how we use the 5 business drivers to understand some of these messages. Now, the first thing we said is, hey, we've got this part of the tool. Let's figure out how many times Brian talks about cash, profit, assets, growth, and people. Now, we don't have time to go through the entire transcript right now. So let me show you my results. And again, you might read it differently. This is where you want to make sure you're meeting with your team to get that better description. Yes. So Heather, yes, this will be available. It also will be recorded. So yeah, you'll get the recording too. So here's what I read. Now, very little on cash from Brian, but a lot on growth, And this is what's interesting is I looked at the rest of them. This is a bank, and they spoke very, very little about cash, a lot about people, clients, and teammates, a lot about profit, a lot about their balance sheet, but their prime focus was growth. Now, why, right? We've got to start thinking the why. Now, I just threw up there what were the analysts focused on? Well, they were focused on profit. And I'll talk a little bit more about this. I'll show you one. But generally, what they're worried about is how are you going to continue to perform? So, how are you going to continue to grow off of a pretty good 2023? That was the main message for analysts. But it's a little bit of a slightly different focus for the analysts. Whereas, again, carefully crafted communication, Brian is talking about growth, growth, growth. So let's think about the questions now. Number one, which driver seems to get the most attention and why? I said growth. Here's an example of why I said growth. This year, 2023 was characterized by a record organic customer activity. Customer activity should lead to revenue, right? Record digital customer engagement levels. So that's growth through people and satisfaction scores. Strong but slowing NII, so good performance for the net investment income revenue during the course of the year. Strong sales and training, up 7% year over year. Operating leverage, reflecting good expense discipline. Solid asset quality, and a strong capital and liquidity position. All of this helped by the years of Bank of America's assiduous dedication to responsible growth. Over a decade, and that's responsible growth strategy. This helped us bring our headcount and expense down. That's an improvement on the expense side of things every quarter during 2023, in line with what we told you to expect early last year, excuse me. So these messages around growth, and they're looking backwards. Hey, this is what we've done for you. And we're setting ourselves up. So when I answered the question, what driver seems to get the most attention and why, I said, well, growth, obviously, it's in there at least 32 times in essentially 2 pages. It's 32 messages around on growth. But what the message was we've got strong fundamentals. This bank is built on a strong foundation that has driven growth in the past in challenging environments. And as the economy normalizes, we're going to do it again. We've got strong organic growth. Now, as you go through the transcript and you look at some of the slides, they called out a couple of key things. They've got 8 business lines. He's given us 4 of the segments here in consumer banking. Look how he's positioning their growth. Consumer banking, the very first thing he says, 600,000 net new checking accounts. Those are relationships, high quality balances. Global wealth management added over 40,000 net new relationships. Global banking added clients and a number of products and added clients and number of products per relationship. 7% year over year growth in the global markets, and the digital tools that they've been investing in are continuing to lower costs. And you can see that in this slide. Here's a summary of everything you just said. And I find it interesting that what has allowed them to grow, the fundamentals, and for them, it's people. It's those relationships. So you saw how many references to people. It was the second one, right? Growth was 32 times. People was 27. So growth is key because it sets up the foundation, the fundamentals of the business, and it shows you how important those relationships are. Number 2, in terms of the drivers. Okay, so around growth, what were a couple of the main points? I think I've pointed out a couple, but let me give you another quote here. This is from Alastair Borthwick, their CFO. So now you have not just the CEO and his prepared remarks, again, carefully crafted communication, but now here's Alastair Borthwick, the head finance guy, carefully crafted communication. Robust client activity in 2023 demonstrates how we grow the franchise organically by winning new clients and deepening existing relationships. How do we grow? People. From record levels of accounts, people, asset flows, and digital engagement to strong balances in sales and trading results, customers and clients continue to see the exceptional value, power, and convenience our businesses offer them. Our strong capital position, in addition to solid earnings, kept us well above our current minimum capital threat requirements. It's a strength thing for a bank, and enabled us, because we were so strong, enabled us to return $12 billion to shareholders in common stock dividends and share repurchases in 2023 while supporting customer growth. Interesting. What are a couple of the key messages? People, right? Our relationships, our balance sheet strength, the fundamentals of banking allowed us not only to grow, but built strengthened that foundation to be able to drive value for shareholders and position us for growth. So a couple of key things, like relationships. We're a bank, yes, but we're about relationships and providing value for our clients. Fundamentals of the business. I've talked about that time and time again. We make good decisions in the operations. We've set our balance sheet up to be strong so that we can have the capital that we need to continue to operate well, make decisions, and invest and build value for our shareholders. And these key priorities have been built, and will continue to build value for clients and shareholders into the future. Like, we kind of captured that. By the way, that last quote, this is why you want to go get the earnings. That last quote actually wasn't from the CFO's prepared remarks. It was from the earnings release. And so just importance there, again, capturing that. Again, coming back to this slide, summarizing the continued organic growth in 2023 and how it set them up there. Relationships, relationships, relationships. Fundamentals of banking, making good decisions, that allows them to grow. So what are some of the goals and trends going forward? Here we go. Back to Brian. We reported solid fourth quarter and full year results as all our businesses achieved strong organic growth. Now, I didn't mention this before, but there are two types of growth. There's organic and inorganic. Let's start with inorganic. Inorganic growth is when we go outside of the company to build it, right? So we're going to go buy another company. We're going to go merge with another company. Mergers and acquisitions are the prime example of inorganic growth. So organic growth doesn't come from outside of the company. It comes from inside of the company. It comes from the resources that we've been investing in. It comes from our current operations. Now, that might be organic, like they opened up a bunch of new branches, right? They're hiring some people. Their organic growth is building the current business, the core business, and the investments that they've been making. So that's why organic growth is really important. Do we know what the heck we're doing? One of those ways is to look at our core business and make sure that's growing. So we reported solid fourth quarter and full year results as all our businesses achieved strong organic growth with record client activity and digital engagement. This activity led to good loan demand and growth in deposits in the quarter and full year net income of $26.5 billion. Our expense discipline allowed us to continue investing in growth initiatives. Strong capital and liquidity levels position us well to continue to deliver responsible growth in 2024. Okay, how do I decipher this? There are a couple of key things I think Brian is saying. These are our priorities, not just that drove growth in the past up through 2023, but here's how we're going to continue to grow. This, for me, again, strategy and performance. We're not quite to performance, we'll get there, but the strategy piece. One of the ways that we can use this tool with our earnings calls is to understand what are the key priorities to continue to grow or to continue to perform. So this part is really important. This part is where I start thinking about, how do I align myself with my CEO's message? What is she actually trying to tell me that I should be working on? Okay. So here's what Brian says, basically. Organic growth, key to what we're trying to do, to our responsible growth initiatives or responsible growth strategy. So organic growth, focus on organic. We're not going to build it by step changes by buying other banks. Organic growth is going to be key. 2, digital capabilities, making investments, huge investments into tech. You think about clients and you think about how we want to interact with banks and how the newer generations that are coming into the economy want to interact in general. We need the digital capabilities. They've paid off dividends, paid dividends for them, their investments in digital, and they continue to grow them. Strong performance. So go back to key, just very good decision making for them, for banking. He says strong performance is net investment income, deposits and lending, like we talked about before, in the capital markets activity, which includes their global wealth management, their trading and securities desk, all of those sorts of things, right? So strong performance in all lines of their business, good expense management, and then balance sheet strength. Now, what will all that do? That allows us to further invest in growth as if we were Bank of America. Now, let's be real here. These are all really high level. I mean, Bank of America is like $94 billion in revenue, 213,000 employees. The challenge then, when we're working with or working in large organizations, is how do I filter these initiatives down to what we do? So I want you to start thinking about that. If I'm working for Brian, if I'm working for Bank of America, or if you know your corporate initiatives, how do I convert that into daily action? So start thinking about that. There's one last question. This sets us up. Here are the initiatives. Here are the goals. We've done it before. We're doing it again. All right. What are the challenges? So this is where I go and look at what the analysts are thinking. Now, Mike Mayo is a big analyst. He's managing director at Wells Fargo, their equities research. Big on banking. Sometimes he's kind of tough on banking CFOs and CEOs and the other executives. Here's one of his questions. He asked, you're only supposed to ask one with maybe a follow-up. He had like 5. Says, as far as controlling what you can control in terms of expenses and headcount, tech investments, and maybe throw in AI as a part of that, what sort of extra efficiencies can you achieve through AI, tech, and other initiatives? You've squeezed a lot out of the last decade, plus what's left to go. So you get this idea that you can only cut costs so much, right? Technology is only going to do so much for you. Eventually, you're going to have to hire. Eventually, you're going to have to invest. You're already investing in digital, but how much more can you squeeze out of that orange, right? And is the juice worth the squeeze? Here's part of Brian's example, or part of Brian's answer. Said, well, you know what? There's always more to go. So I think we've got lined up. If you take what we're doing this year and next, meaning 2024, 2025, and even roll into 2026, it's a couple of $2 billion plus, which helps us to, Erica was talking about avoiding growth and expenses. Erica's another executive there. I was talking about avoiding growth and expenses, keeping below inflation. So controlling that cost growth. Because you think of us rolling that expense, taking out back into good things. This is kind of word salad to me a little bit, but this year will be, I think, $3.8 billion on technology initiatives. So there's the investment. That's up from 2021 to 2022 by $500 million or more, then sort of flattish in 2022 and 2023. They're being applied in different ways. What is he saying? Brian's saying, look, this is part of what we do. That disciplined cost management. It's part of what we do. There's always room to improve. This is that growth mindset. We're still trying to learn, right? We're still trying new things. We're still making investments. So here's one of those things where I can use this tool in my own role. Okay, I know expense management is a key part of the strategy. We've seen that over and over and over and over again through Brian's comments. And now we're seeing analysts ask about expense management and how much more there is to go. And here's Brian saying, no, this is it. There's still more. We're still trying to learn. We've got that growth mindset. We're still trying to capture more. And we're investing. We're spending money to save money. So in my role, what can I do to help out with that disciplined cost management? Am I disciplined with my cost management, with the way that I manage my budget? Am I contributing? Am I looking at digital tools? Am I using the tools that I have to their fullest extent So we get the most automation. So we get the most accurate and timely data. So we can assimilate and use all of that data to make good decisions that will grow our top line, grow our revenue, and manage costs so their profits can grow, so we can build value and reinvest back in clients, customers, employees, the communities that we have. So that's kind of how I'm thinking. Now, here's another thing we talked. Bank of America actually talk a lot about their expenses, and one of the ways they do it is just looking at their non-interest expense, which for a bank is the overhead. So here's the overhead of the company, and you can see over the last 5 quarters the trends there. Now, there's this little piece here that had to do with banking. When Signature Bank and Silicon Valley Bank failed, the FDIC, the Federal Deposit Insurance Corporation, jumped in and covered all those deposits. Now, where did they get the money to do that? Well, they get it from banks. So one of the things that the FDIC did was they started saying, okay, bank, you're this big. Here's your share of recouping those losses. So a $2.1 billion charge was what Bank of America's share was. So one of the things that they do is they say, hey, look, if that hadn't happened, what's our normalized run rate? We're at about $15.6 billion. And so now you look at this trend, Q4 2022 at 15.5, kind of peaks at 16.2 in Q1 of 2023. And you see this go down little by little. So this is what Brian means. We've got room to go. Now, the other thing to look at is this efficiency ratio. This is comparing their expenses to their revenues. And so you've seen with that $2.1 billion charge, you see that kind of tick up a little bit. And he's saying, look, we're capturing the normalized part. We're making investments to continue to improve. We don't think that we know that $2.1 billion isn't going to be happening every year. We're in good shape, but we're going to continue to grow. So if you looked at all of the questions for analysts, a lot of them dealt with profit. So anywhere from, hey, what are you looking at in terms of rate cuts? Again, interest rates have a big impact on banks and their net investment income. So what's happening there? What are your challenges to revenue? Persistent performance across the segments, given the direction of the economy. So do you think the economy is going to improve? Either we're going to have a recession. Tell me about the quality of your assets to be able to continue to drive profits and earnings per share. Further expense management, as we saw with Mike Mayo's question. So those are just a few examples of the questions, and you can see where analysts are thinking. Like, what are the challenges there? Now, we've been through the analysis on the transcript. We've got to start thinking about performance. And does their performance support this messages? But more importantly, does their performance set themselves to be able to achieve the strategy that they have? So let me show you a couple of examples here. Now, this one, banks think slightly differently, but there are a couple of key things like net profit margin. You're going to see an interesting thing with equity ratio. But when you get to growth, it's all the same. Banks for a bank, if I were going to sit down and do this, I might have slightly different metrics. But in general, this will get me there. And this is in the tool too. So here's a performance worksheet that helped me guide performance. You can see we're going to compare current year to last year. We can compare it to some competitors, peers, maybe even customers and clients. Okay, so let's just start with cash and cash equivalents. Now this says, here's the equation, what we're looking for, the metric. We're measuring the cash driver, and this column tells me which statement to look at. So I've got to go find cash and cash equivalents on the balance sheet, and I'm going to put my answers there. Now, in some cases, we've got equations which we'll put there. Now, here's the balance sheet, 2023 balance sheet. And usually cash is right there at the top. So they've got 2 lines, and banks, again, they're a little weird, but you've got cash and due from other banks, but then you've also got these Fed funds. So you add that all up, you take that $333 billion in cash, and you're going to put that right at the top. Now, looking next, cash flow from operations is next. So I'm going to go look at my consolidated statement of cash flows. And this is broken up into 3 different sections. Here's cash from operating activities, which is what I'm looking for. But then you also have cash from investing activities, cash from financing activities down there, and then change in cash down at the bottom. But Here's what I'm looking for, this top part. And I want to key in on this $45 billion. That's the net cash provided by core operations. Now, for most operating companies, this is a key metric. This is what the cash that we use. Well, first of all, it's the cash that we've generated over the last year. And that's the capital that we have to be able to invest that keeps us in business. So $45 billion in cash flow, strong, very, very strong. Okay, so keep going down. They've got very, very strong cash performance, but it's a bank. I'd be really, really worried if a bank, one, didn't have cash and didn't have strong cash flow. Now let's take a look at performance, knowing what the heck you're doing. So let's take a look at revenue. Now, banking revenue on the income statement is split into two basic things. One is the net investment income, that $59 billion, but they are also charging fees for other stuff like their wealth management, private banking, those sorts of things. So now you've got trading. So now you have all of the non-interest income. So I'm going to add up the net investment income or net interest income and the non-interest income to get the $98.5 billion of total revenue. And that's the number that I'm going to put in. The 95, excuse me. It's kind of small on my screen. So about $96 billion in total revenue. Okay, great. Now it's just a point in time, so it's important. I'm going to go capture revenue growth down there below. If I wanted to go on like net income, I'd come over here and I'd grab net income, apply, excuse me, my mouse is going kind of crazy, clicking all over the place. I'd come in here, net income applicable to common shareholders at $25 billion there, and so on and so forth. And what I get is this sheet. So I'm going to do this year. I'm going to compare it to last year and see the performance here. Couple of key things I'd show you. Now, one thing here, banks manage risk. They also are peculiar. Equity ratio is like your own net worth, the ratio of your net worth to your assets. Banks are usually low. Banks, like guidelines for equity ratio should be somewhere in that 20 to 60% for a normal company, normal like publicly traded company. Banks are usually below that, 15%, 10%. You can see here, 9.2% for Bank of America. If this were a regular operating company, I'd be a little bit worried, be saying, hey, you've got too much debt. But for a bank, their whole idea is to lend out all that money. They don't want to have a whole lot of equity just sitting there. Now, they do have to balance that with how strong and well capitalized they are, but generally that's going to be a lot lower. You think about the size of their balance sheet, $3 trillion. Usually return on assets is pretty low as well. So those things are going to be a little bit peculiar and very not real comparable to a company that you might be familiar with. Down here, growth. This is interesting, right? So 3.8% top line growth, but their earnings growth is down and their earnings per share growth is down. Now you can start seeing a little bit why. Again, a couple of things happen. First of all, especially as you compare it to the rates of growth in 2022, there were some one-time things. Now, anytime there's a one-time charge, like we saw with that $2.1 billion FDIC charge to Bank of America, one of the things that the companies will do, and more companies do this more and more often, is they'll start adjusting some of those one-time things out to see what a normal run rate is. These are what we're calling reported numbers. So GAAP, generally accepted accounting principles. Now, if you're looking at a company outside of the US, they're going to use International Financial Reporting Standards, IFRS. These are the reported numbers that are reported according to those things, those rules. If you were to adjust those one-time things out, it would tell a little bit of a different story. So even though they've got a decline in net income and a decline in earnings per share, I'm not super worried, because if you adjusted those one-time things out, it changes the story. Now, does this set them up? Yes. Strong performance. They've got a strong net profit margin. We start seeing things like cost inflation. They're working on cost inflation. We start seeing things like the impact of lower interest rates and cuts that impacts their revenue. So those sorts of things I'm taking into account. I can also compare them to like a JP Morgan, the largest bank out there. I could compare them to Wells Fargo, some of their other sizable competitors to figure out who's doing well. And like, I'm going to go look at Wells Fargo and I might start asking questions. Well, why did they perform so well while Bank of America was a little bit more challenged? So that's the analysis. We've gone through the strategy. We've gone through the performance. Strong performance sets them up well. There are some better performers out there. I'd be asking why. What can I do in my role to help them? And that's where we want to go next, the application. Okay. So this is a quote I love, right? To do and not, sorry, right here. To know and not to do is not to know. Did you make your bed? No. Did you know you needed to make your bed? Yes. So did you really know that you needed to make it right? And so we've got to make our bed, right? We've got to be able to apply these sorts of things. Now, this comes with, like I was just showing here, experience with 34 Fortune 50 companies. We've done this for the last 20 years, where we find the biggest impact, where you can get the biggest return on your investment and time and effort is to think about the application. The analysis is not enough. We've got to think about the whole with them, right? What's in it for me? The whole so what? So how do I use that information to either improve my influence and credibility or to improve performance where I am? So we've got to think about that. That's why we've got this page here. What are you going to do? Now here, I had an epiphany. Now I've been doing this for 10 years, but I look at banks and I look at operating companies from a lot of different industries. And it occurred to me finally, like light bulb moment, it doesn't matter the size of the business. It doesn't matter the industry. It doesn't matter what business you're in. It doesn't matter whether you're in a strong market or a weak market. It comes down to fundamentals. And what are some of those fundamentals? Number one, relationships with customers. Do I know who my customer is? Do I know them so well and what they're trying to do? I know the job that I can anticipate what they're going to need and build value for them even before they know it. Am I making good business decisions? Am I managing my budget well? Am I building those client relationships so they build value for the company? And am I being disciplined about how I capture that value? Things like pricing and sales. Do we manage our business with some discipline? In other words, do we have a strong balance sheet? Do we have enough to keep us around and give us options, flexibility to be able to invest? And like we talked about before, strong cost discipline. I've always worked in cost centers. So strong cost discipline really resonates with me. So what insights did you gain? And now, what are you going to do about it? So things that you might think about, things that I would do going from here, like I mentioned before, I looked at JP Morgan, I looked at Wells Fargo. Next steps would be, why did JP Morgan and Wells Fargo outperform Bank of America? Wells Fargo had 40% net income growth. What really happened there? And why isn't Bank of America growing as well? They had a decline in net earnings. All three of these banks are going to have that same FDIC charge of some sort, right? They're all facing the same market. So what did JP Morgan and Wells Fargo do that Bank of America didn't? Well, what would that help me with? Well, first of all, I could share it with other consultants who work with financial services or who have banking clients. And we can talk about that and think about what all of our clients are doing, put our heads together and kind of find out what are the best practices out there right now. The other thing, in my position, I teach people how to use this stuff so I can get real clear about how I can help Bank of America and maybe help them make good business decisions that are, one, aligned with their strategy and have the intended financial impact. So those are things that we can do. And then now, where do we take this? Where do we go from there? Well, one, if you've analyzed your company, think about talking with your team, talk with your manager, think about the action plans you're going to take. Make sure that they're aligned with your organization strategy and with your own functions strategy as well and initiatives. If you analyzed a customer or partner, maybe meet with the sales manager, the account team, talk about the insights you've seen there. How do you help your customer improve? And then if you analyzed a competitor or bank benchmark, think about how you can use best practices that you've seen in the market and for better performance and better competitiveness within your own markets. So now we've gone through this process where we're looking at the preparation, found those resources. We did the analysis, the strategy and performance. We talked about the combination of the two. And now we're saying, so what? How do I use this? Okay. So real quick quiz. What was the second step? You locate the transcript, and then you meet with your team. What's the second step here? Love it. Love it where you're going. Good, good, good. 100% correct so far. Excellent, excellent. Thank you, Julio Cesar. Thank you. 2 seconds. Yeah, 100% of us. Perfect. 100% of us are saying review our past call notes. That's exactly right. Now you're going to say, well, maybe this is the first time I've ever done one of these. Yep. Start now. Right now you've got notes. Now you're going to do this every single quarter. You're going to go get the resources. You're going to go do the analysis. You're going to make the connections to strategy and performance. You're going to figure out how you can align better to strategy and the current performance in the current market and apply what you know. You're also going to meet with your team to be able to do that. So your challenge, who are you going to analyze next? We just did Bank of America. Maybe it's the company that you work for. Maybe it's the company you sell to. You want to understand a customer better. Maybe it's a competitor. Maybe it's a vendor. Hey, is this a strong vendor? Maybe it's someone you personally want to invest in. If you're interested, on April 25th, and even if you're not, come anyways, it'll be fun. We're going to go look at Salesforce. Now, Salesforce, huge player out there. We're going to look at their latest earnings call and do the same debrief for Salesforce next time. So most of you, 60% of us, are going to go look at the company you work for. Let's see, 11% company you sell to. Awesome. This is huge in understanding customers and clients and what they're trying to do. Company you want to invest in, company you're interested in. Sorry, that's not General Mills, but Salesforce. Sorry, I didn't catch that one before. So next time, hopefully we'll see you again. I know that this stuff, you can get we've got the link there, April 25th. We'll see you again. And if you want, you can get $100 off, $100 coupon off for our e-learning. With that, hey, thanks for being for sticking in there with me. I know sometimes this stuff is a foreign language. I get it, and especially when we deal with banking. But this stuff is critical for you, for your success. It will help you build your career and help your company's performance as well. Hey, it's been a pleasure. Thank you very much.